Okay, so today is Thursday, July 31st. This is the makeup session from Monday of this week. This class is being recorded. Appreciate everybody's flexibility. And for those of you that couldn't make the scheduled live session this week, please feel free to watch the recording and reach out. The plan is to go back to our normal schedule on Monday and going forward. So with that in mind, this week, you spent a lot of time building kind of the base BMW model. And so before we go forward, did everybody successfully kind of match the video and get everything working? Did anybody have any challenges with that you wanted to ask about? Okay.
Professor, I hope you're doing all right, by the way.
Oh, thank you.
But yeah, no problems really. I didn't change the formatting for the number of decimal points to which it rounds, like you did in the video. Is that going to be relevant or important, or is that fine?
No, that's fine.
Okay.
And
I didn't think it
also
would be a
listen,
problem.
you left it in dollars, you didn't switch it to euros, and that will be fine as well. But again, it's just checking. Was everybody able to kind of match the video? Any problems? All right, great. Part of the reason why I wanted to split the assignment into two pieces and match the video is that if you kind of match the video, then that tells me that you kind of built a model that should work, and hopefully will not give you problems as you start to reuse it with other companies, right? But again, just as a reminder of what you've accomplished last week, is that what you did is you took a company, in this case, BMW at the time, you took their historical data, you basically created a series of ratios based on that historical data. You then forecasted those ratios into the future, which created the forecasted financial statements. And those forecasted financial statements forecasted the economic statements, and particularly the CFI, the cash flows. Okay? And since the company's worth over the sum of the cash flows, then basically, Miller, you built a valuation tab, which said, okay, given the operating cash flows, which was the free cash flow, and the non-operating cash flows, and together the enterprise value paid off the debt and the non-common equity, and you essentially got a share price. Okay? And that is a pretty standard model used on Wall Street to value companies. Okay? And so essentially, what we've also done with the model data tab is we've kind of set this spreadsheet up so that we can adjust. Okay? Adjust companies very quickly. So it might have taken you, I don't know, hour or two to build that model to this point. It'll take you 10 minutes to do company number two. Okay? And then that will lead to this week's assignment, where we will go further and we'll start creating the other files. Right? And the other files will be, and what you essentially have created is what we're going to call the first file the as is. Okay, so we will, and this is in the video as well, but essentially we're going to value the company at the price at the time. Okay, and it's not whether we agree with the price, it's just what is the price as of the day of the valuation. Okay, and then from there, we're going to create 3 more Excel models, basically just copying and saving. And we'll call one the bolt, one the bear, and the last the target. And the whole idea is that, all right, we value the company today, and we have a pretty good idea of what the cash flows and therefore the earnings are likely to have to be to justify that share price, okay? Plus or minus a little bit. And so from there, we'll say, okay, where do we think the company could go in the next 12 months? How high could it go? The bull. And what's going to be important about that is not just putting in numbers, but the assumptions for the numbers. Like, why do you think growth is going to be X? Why do you think margins are going to be Y? Same thing with the bear. Hey, tariff effects for this company might be more sensitive. So therefore, what we're going to do is we're going to lower the growth or lower the sales or lower the margin. And we'll see what the bear scenario is and what share price that would be. And then once we've established that range, that's when your opinion comes in. Okay? And that's called the target share price. And what Wall Street uses is what they call a 12-month target. Right? Reasonably, where do we think the company will end up in the next 12 months? And that is somewhere between the bull and the bear. And from there, once they kind of establish a target share price, you compare your target share price to the current share price, and that's the basis for your buy, sell, hold opinion. Right? Some banks use a slightly different range. Most banks use plus or minus 10% of the current share price, and they call that a hold trading range. So I'm not going to recommend to my clients that you accumulate more stock because there's not a lot of upside with their trading range. If I think that in the next 12 months, the company is going to go more than 10% up, I'll call it a buy. Buy it now, they're undervalued. And if I think that in the next 12 months, they're going to sell it, or sorry, they're going to go down more than 10%, then I might put a sell recommendation. Now, in the real world, there's a bias. It's hard for a bank because these people work for banks. If you were the banker for Union Pacific Railroad, who just announced a major acquisition, and before that happens, Union Pacific approaches you and says, we would like to work with your M&A team and your investment bank about exploring options, and your sell side analyst is saying sell, sell, sell on the company, it makes it a much more difficult conversation. So there's a little bit of bias. And you start to learn over time in the real world that some holds mean sell. And it's not that they're truly holds, it's just they really just don't want to piss off the clients and lose a lot of fees. Okay. So, but generally, playing it straight, that's the idea of the buy sell hold opinion. And the other reason for the buy sell hold opinion, which I talk about in the video, is that if you're doing portfolio management and you want to put Union Pacific or somebody else into your portfolio, or you want to diversify. And if you're diversifying a portfolio, one of the things you need is price against standard deviation, because the standard deviation helps you create a diversified portfolio, understanding what the standard deviations could be. Hence, the bull and the bear. Okay, so the bull and the bears are very important on Wall Street. Now, most of the press focuses on the target share prices. Okay. And again, just taking Union Pacific as an example, because they're in the headlines this week, which, by the way, can somebody tell me why they've been in the headlines this week? What was the big headline for Union Pacific Railroad?
I think it was a merger with the other railroad.
Yeah, they're acquiring probably. Who's the other railroad? Big monopoly. There's 4 of them.
Is it Norfolk Southern?
Yeah, they're buying Norfolk Southern. Which is interesting. We're down to 4 railroad. Now we're gonna have 3. And Union Pacific has just created the first nationwide railroad, because the Union Pacific is mostly from Texas through Chicago to the West Coast, and Norfolk Southern is pretty much east of that. And now Union Pacific controls the rail lines from, the ports of New York, the ports of Charleston, South Carolina, all the way to the West Coast ports of LA and, San Francisco, Seattle, etc. And I guess antitrust doesn't matter anymore in this country, because the odd man out, which is CSX, which is again another East Coast railroad, does a lot in the Baltimore area, by the way. Long story short, they're like, well, maybe we need to merge with Burlington Northern, which is owned by Warren Buffett, and create our own nationwide railroad. So it'll be interesting to see how that plays out. So we might go from 4 railroads to 2 railroads in this country in pretty short amount of time. But hey, it's quote unquote good for competition. So in any event, what I wanted to do is jump here to Bloomberg. And if we were to look at Union Pacific, ANR is the short code for analyst recommendations. And these are the current buy, sell, holds on the companies. In fact, you are doing the same thing as part of your assignments coming up in your group projects. So over here are 36 analysts. Actually, we have access to 29 of them. For some reason, we're missing 4. But of the analysts that are covering those 29 analysts, okay, those at the screen. You can see a bunch of target share prices. So no different than in your model, they are modeling out the cash flows of where an intrinsic value they think the company is going to be over the next 12 months. And what Bloomberg is doing here is they're just aggregating all the guesses. And that's where this essentially 12-month target comes from, about 267 a share. It's just the aggregate of all the guesses today of these people. Well, they all their models. Right now they're trading at 221, which means that Wall Street's pretty bullish on this and thinks there's 20% upside based on today's share price of owning Union Pacific in the next 12 months. And they were down 8% year over year to this point. So they're making up the 8 and they're kind of gaining net 12. But based on today's price, there's 20% return. That's why you can see Bernstein, Barclays, RBC came out with buy ratings. Okay. JP Morgan, it's interesting, as a 267 share price, they're calling it a hold, even though they're at 221, bigger range. But regardless, some analysts didn't like the 1 person who doesn't like it. Loop Capital doesn't seem to like it. I don't know who Loop Capital is, but Rick Peterson. But nonetheless, in a way, that's the process that we're going to be going through last week and this week in terms of your assignments. So again, questions, comments about any of this so far? Make sense? All right, and again, because of my illness, I was a little delayed in giving you guys the data. And I plan on working on that tomorrow. I now have a lot of free time where I am. And basically, part of the data is going to give your teams the data to do your own valuations. Okay, so when we practice as part of your next week's assignment, the target, we're using the model, then you're going to do that individually. But what's coming up is that you'll take one of your individual models that you did with your team, and you'll use it to do each of your group project valuations, which all those presentations coming up in a couple of weeks. Okay. And what's key to all of this is not just the numbers. It's why are you making the assumptions that you're making? That's just as important as the numbers. Because anybody can say, oh, target's going to grow 5%. Why is it going to grow 5%? Why not 6? Why not 4? Why not 10? You know, what's the basis for this? In a way, that's kind of why we do EIC. Right? Because the EIC gives us some details in the industry and the company that will influence some of the assumptions that we make in the models that we will work on. And to some degree, that's what we do historical, because at least it sets a baseline for what is potentially reasonable for a company, particularly a mature company like the Union Pacific Railroad, because they're making a certain amount of margins, call it 35%. Historically, you don't want to model out 50 because that's a big jump, and you have to kind of explain that in a more realistic sense. So that's kind of where we're going with this. I'll pause. Make sense? Questions? All right. So what I thought we would do here is a little bit of mix of last week's assignment and next week's assignment, but with a different company. Okay. So next week or this week, you guys should be using these models to work on Target using a model. So I thought maybe we take Walmart or Costco and quickly do an example here in class to give you a sense of what you're doing in this assignment to help everybody maintaining what you're doing. Again, it's in the video, but it never hurts to see a practice and question. So I'll ask the group, which of the two other retailers would you like to see? Would you like to see Costco or would you like to see Walmart?
Costco for the hot dogs.
I mean, I give, my donation every Sunday to them. So. Anybody object to looking at Costco?
I'm a pro Costco fan.
All right, let's do Costco.
I'm good with Costco.
So what's going to happen behind the scenes in your group project, unless you have access to Bloomberg, is I will be going to Costco in Bloomberg. And one of the features of Bloomberg is it has historical data. Lots and lots of historical data. Okay. Now, our model is set up to use 6 years of historical data. Okay. So what I'm going to do is I'm going to go to a custom template that has already been created called model. There we go. And this is 6 years through 2024. Now they have a weird fiscal year which ends in September, but regardless, if they're 2024 fiscal year of income statement, balance sheet, and cash flow data, and that exactly matches the model data tab in the model you use for BMW, okay? And you'll be using for Target. Okay, and the key here in this process is that this data has to be put in exactly row for row into the Excel spreadsheet you're building, or it's going to break things. Okay, and that's going to be very important when you kind of reuse the model. So what I would have done for you is I export this data to Excel. And it's a version of Excel that has a Bloomberg add-in. Because Bloomberg will not export to a regular version of Excel without the add-in, because it's accessing the company's database. And you have the add-in because it says Bloomberg here on top. And then it gives you the data. Now, what's interesting is the data. Update right now, thank you. The data that I'm actually exporting, if you look here, are not numbers. They're actually database references. And one of the nice features of the tool, FYI, is that what a lot of people on Wall Street do is they don't actually use Bloomberg. They just use Excel. And they basically just call the data from Bloomberg in real time. So that every time they open their Excel files, it just refreshes with the most current data. And you can pretty much export anything and link it out of Bloomberg. Now, the challenge for you is you won't have Bloomberg. So what I will do next is basically copy this entire spreadsheet and paste what did we do this? Paste special values. So I'm going to turn all these database lookups here. Into numbers. Again, you wouldn't have done this, but this is what I will do for the target. I will do for all your individual project numbers. Okay. And the other thing that I will do for you is Excel chokes on these in formulas. You cannot have a dash in Excel in a formula that you are using. And they're basically zeros. It's either NA, they don't have it, or it's a zero, but for whatever reason, Bloomberg gives dashes. So basically, I'm going to get rid of all of these dashes and replace them with zeros. So if you ever actually have access to a terminal and you try and do this on your own, this is a very important step in the process. Because otherwise, when you put the data in your model, it'll error out if there's any dashes in there. And then I'm going to basically save as. Downloads folder. And the format that I will use for not only this, but your companies is I'll put the ticker symbol, cost for Costco, and I'll call it the data file. That is the one called TGT data as part of this week's assignment. From here, you don't really need Excel anymore. Away. Wow. So what's going to happen to you, stop there, is you'll open it up Excel. Open up my Excel again. My Excel. I hit trouble with Zoom on my laptop today. Let's share again. That is the file that I will be giving you. I've given it to you for TGT, and I've given it to you for well, BMW is already in there, and I'll give it to you for your group projects. So basically what you then do is you take a valuation model. Let's say I do. I'm not going to use target because I don't want to give you a solution today. Here's one I did last spring on Hermes. And on this model data tab, and this is the very important part, it's got the Hermes or Hermes data. You take your Costco data. In your case, you'd be taking your target data, put it in the BMW model. You select the entire worksheet. You go to, in your case, BMW. Hit you. This thing. Yeah. You select the entire, in your case, BMW model data tab. And again, paste special values. Now, the reason why you're pasting the values, paste it correctly. You do that, as opposed to just copying and pasting, is that essentially if you copy and paste, it'll make references to the original file, and that's going to cause you problems. I think I hit the paste button. Sorry, I'm having trouble with Zoom and my mouse. So uh, select the whole tab, edit, what is this one? Paste special value. So what it should do is cell by cell, row by row, overwrite all of this with the 6 years of historical data. Okay, so now this file has become your Costco data, which means, let me save this, put it in my downloads folder, and we're going to call this valuation model Costco. And as part of this upcoming week assignment, as is. But a couple things. When you go to these ratios, if you made some changes to these ratios, they're still going to be here from your last company. So for example, well, this was the Hermes, but the BMW margin is EBITDA margin or tax rate, whatever you typed in, could still be lingering in the model. So one of the things that's important, and you can get some really weird share prices, is I like to go back and make sure by just saying equals previous year. Same thing, equals previous year. Equals previous year. So that if there's any lingering BMW hard-coded information when you're working on Target or any other company, that it doesn't stay in your model. Because that can just be very, very frustrating. Like, why doesn't the share price work? Well, if you're using BMW's EBITDA margin, not the company's EBITDA margin, then you could end up with a completely different type of evaluation. So that's just another practice in the model, which is why I think I mentioned in the video, we wanted to limit all of the places where we are making changes to 2 tabs, ratios and assumptions. Okay, but that's the next thing. From the assumptions, these were the previous company's assumptions. Okay, and so the first thing that you're going to need to make sure you check, what was the last year of the company that they reported? Well, Costco's 2024. Time I did this for Hermes is 2023. So I'd have to update that. Now, I'm going to need a current WACC. Well, this is where Bloomberg will come in. So I will give you screenshots. I did for Target. And I will for your group project companies. But the screenshots that you're going to get are the WACC, which today is 8.2%, right there. Screenshot. So this will be Costco's WACC. I will give you a second screenshot called DES. Stands for description. I'll be description. Oh yeah, Cliff Notes overview. And you'll get 2 things off of this. This is the price at the time of the valuation. And down here is the current shares outstanding of Costco, which will be different than Target or anybody else. The next screenshot that I'll give you is called the EEO. These are the earnings estimates. This is the baseline, which is the average of the analyst guesses. In your case, particularly for revenue and EBITDA margin. So rather than starting from scratch, we're going to start with the consensus. for the next 5 years. And as somebody pointed out to me, by default, only gives 4 years. So what I'm gonna do for you, is I'll give you Costco EEO. And likely, I will move this over a column. Let's go into the future. Get to the 5th year. And I will call this going forward, Costco EEO2. And it's basically the same earnings estimates. I'm just giving you an extra year's worth. Now, the other thing, let me do this, is in the screenshots that I give you, you'll see some of this here at the bottom, the multiples, which are going to be very important in the evaluation. So essentially, if I go back to here, the Costco model in this case, I start updating what we just saw. So what was our whack again? Based on a screenshot. Was 8.2. G, we're going to solve for that. So I'll just reset it to 30% as a starting point. Shares outstanding for Costco, that is on the DES screenshot. And right now their share count is 443.5 million. Some reason I had already in there. Next, we'll need their current share price, which is also on the DES screenshot. And today Costco closed at $939.64. And then the last thing, based on what you built in this week's assignment, is we need to put in the revenue forecast and the EBITDA margin for the Costco, and so therefore the EBITDA, create the margin for the next 5 years. And this is just transposing data from the screenshot. So off of the EEO screenshot, 2025 revenue, 274,797. So 274,797. No decimal places. Right? So 274,797,000,000. 2026, 295,489. And 2027. Stop, Apple. Today it is 317,093. And 2020, that was 2027. 95 and 2026, I believe. 2027 is 317. 2028. Consensus revenue is 338,744. And 2029 off the EEO2 is 359,746. I'm on the screen, I'll work backwards for the EBITDA. 14,791. $13,891. 12,724. $11,511. And $25 is the first EO 10,415. So today, even with the tariff impacts, about a 4% margin. That EBITDA margin that Wall Street's expecting for Costco. And so on the ratios tab, this EBITDA margin, which has historically been closer to 4 or 5 or 2, is expected to drop closer to 4 on a go-forward basis. That's the consensus of Wall Street today, given these cash flows. And then finally, oh, I forgot, there's one other screenshot I will give you called guidance. We need a tax rate for the company. And the analysts need one too. So the first question is, the company going to give us one? What do you think their tax rate's going to be in the future? So there'll be a screenshot called guidance, and jump in the interest of time. But right now, Costco is guiding towards a 26% tax rate. So 26% going forward. Now, this is another point I had made before. We're not really changing these balance sheet ratios because as revenue grows, so will the balance sheet at the same rate, same constant productivity. And so essentially, if all these numbers come true, and you can go over here to your CFI, it will generate these growth cash flows and these free cash flows, which by the way, is hidden in this one. Unhide it. This is where you get your CFI worksheet for the second part of the project. Double click. Click. Unhide. It will give you the forecasted free cash flows based on those. And again, another important check, make sure your CFI is balanced down here at the bottom. There's no problems with the data that you've imported. But the final point is Costco trading at 939, the cash flows say they're worth 278. So the one final key is here on the assumptions tab. We need a long-term G. This is the perpetuity value of the company. That reset to 3%. And in the valuation that you're building, that number is going to be very important because it is going to drive this continuing value. And this is pretty true of most companies. The continuing value for Costco, meaning beyond 6 years and going forward, is 104 billion. The next 5 years are worth 20 billion. So most of the value is in the continuing value. And that's the key value driver formula. So getting the ROIC right and getting the G right in perpetuity is kind of important because that's going to be the entire valuation of the company. 80% of the value, plus or minus for most companies. So what we are doing in this class, I believe it's easier to forecast ROIC than G. Slight changes in G can really affect value. So in this week's assignment, I'm having you solve for G. And so that is goal C. So what you're going to do is you're going to basically say set cell to the current share price. And so you want, not there, you want the DCF valuation share price. Set cell DCF valuation share price to the share price that you want, which is 939.64. By changing G until you get there. And Excel will basically say that to get to that share price with these assumptions, the market's using a G in perpetuity of 7%. So long term, they're still expecting pretty high growth out of Costco. And so now we have an as is value of Costco at 939.64. Okay. And the other thing is, we want to do a sanity check on all of this. Down here off of the EEO screen are the trading multiples based on today's share price. And that's called the enterprise value to revenue multiple and the enterprise value to EBIT multiple. So back on the EEO screen for Costco, today, and we're going to use the second and third forward year. Okay, so just switch this back to Bloomberg. Down here at the bottom, you will count forward year 1, forward year 2, forward year 3. Okay. Top, forward year 1, 2, 3, 4. Okay, it's kind of convention. We're going to use these 2 years. And we're going to use the current EV to revenue, 1.39 and 1.29. Go back to Excel. 9. $1.29. And we'll then use the EV to EBIT multiple, 35.64. And 32.24. Stopping the share. Resharing Costco. What I did in the background. Took these 2 numbers. For EV to revenue, these 2 numbers for EV to EBIT, because, and this is in week 6 and in the books, if you divide EV to revenue by EV to EBIT, you actually get your EBIT margin in perpetuity. So the trading multiples basically say that somewhere between 3.9 and 4% is what they believe Costco's margins have to be based on its actual observed share price in the marketplace. The analysts think it's going to be 4.1%. So you can make an argument based on the trading multiples that there's a little bit of a disconnect, not much, between the price of Costco and what the analysts are saying. So remember that the price of Costco is driven by the buy side, people, the institutions are buying the stock. And this number that I have the sell located on is driven by the sell side, which is the people that are doing the research, talking to the buy side about what they think the stock is worth. It's not dramatically different here. It could be for some companies. And so this is the range that we want to be in. So a little bit above that range. So one of the final things we should have done is pick a number in that range, go back to the ratios tab, and essentially that is this. That's your EBIT margin. We're calling operating income in the model. And this is the perpetuity period that number for EBIT margin needs to be 4%. Now, right now it's 3.2. So the question is, how do we make it 4? It's a white cell. So what we're going to do is we're going to change the EBITDA margin to get to the EBIT margin. So if I need to go 3.2 to 4, I have to add 0.8%. So I'm going to come here and I'm going to make this 4.9. And now I have an EBIT margin of 4, which matches the trading multiple. And this is going to be very interesting, because what this is telling me is there's a little bit of a disconnect in Costco's margins in the future based on its current share price between what it's trading at today and what the analysts think it should be trading at, which is maintaining a 4% EBITDA margin. The market is pricing Costco today as that their EBITDA margin is essentially going to go up to almost 5% in the next perpetuity period, but the next 6 years. So what that also means is we have a difference in share price with a higher margin. So we will need to reassess the growth rate that we just put in here. So back to assumptions. I'll go back to my G and say, based on the trading range of the stock price today, Costco is not expected to grow their earnings and sales at 7% a year. That's on a goal seek basis. If I set their share price if I set their share price again, if I set the model share price, you tell me what growth rate $939.64, which is the analyst targets, by changing the G, then basically what the analysts are saying is let's sell. Closer to 6.7%. You might say 6.7, 7.1, not that big a difference, but when you compound, it's actually a pretty big difference. But nonetheless, that's the other step in creating an as-is valuation. So what we've done, and I'll stop my long diatribe, is we've taken Costco's data, we've put in the consensus, we've used the multiples to help us kind of triangulate what the long-term margin of Costco should be. And there's academic formulas that back this up. And we've said that Costco is going to grow a little under 7%, 6.7% a year to kind of justify this share price as a baseline. And that is called an as-is valuation. So that our model now matches exactly the current share price of these cash flows. So assuming all this comes true, that's approximately what we would need to get to Costco's price. So I'm gonna stop. Questions, comments, concerns, crippling fears, but anything we've been doing. Again, this is part of what you're gonna do for Target, part of what you're gonna do for your projects. And next Monday in class, I'm gonna give you the data and you're gonna practice yourselves while we're in class. And you'll be faster than I was tonight. All right, so let's do a bowl. File, save as, Costco, bowl. In an optimistic scenario, over the next 12 months, what could change to make these numbers go better and why? I'm going to ask this of the group. What could change here? Revenue growth rate, EBITDA margin, tax rate. To make this be better. What would you say?
Who could reduce their COGS?
So translate that. Reduce their COGS, which would lead to what?
Like reducing costs would include or would increase their GPM.
Okay. And therefore probably increase their EBITDA margin.
Yeah, sorry.
Okay. Then why? Well, what's the kind of business rationale behind that?
Implementation of AI.
I'm sorry.
Implementation of AI in certain areas.
So using AI in their supply chain may give them some cost advantages.
Yeah.
Okay. So translate that to me into an EBITDA margin. What's going to change? And by how much of these numbers? So right now in 2025, 2026, 2027, when do they start seeing the benefit of this?
I mean, partially in 2025, but probably more so in 2026 and beyond.
Okay. So I know you're not supposed to overwrite these numbers. So you'll see in the video that I'll start making these cells yellow again. What should the EBITDA margin be in 2025? Right now, it's expected to be 3.8 by the analysts. You're saying it's going to be better than 3.8. What's better?
Well, maybe like if we're assuming that they implement it today, like obviously, takes time to like, get through the supply chain. So it'd probably be like marginally better, but not much. Like maybe closer to like 4.0. But
In 26 or
in
25?
sorry, in 2025, yeah.
We'll make that 4. Okay, what about 26?
So just going off historical, maybe maybe they get it back up to like 4.5.
Do you think within 2 years that their margin is going to return to where it was in 24? I'm just repeating what you told me.
Yeah, I mean, yeah, like,
That's
yeah,
all.
no.
Yes, no. You want to pick one?
Oh, yeah, sorry. I thought you said no when I said
I
yes.
said tariffs and
And
all, and you said no. So they're going to not be too impacted by that in the margins.
oh, tariffs. Oh, I forgot about that part. Yeah, so I guess maybe that instead they're, maybe just a little bit above that 4.0, like 4.2.
Okay.
Instead.
And then what happens between here and there?
Probably slowly creep up and then like, I mean, theoretically, this is like
Give
assuming
me a
some
number
big
for
thing.
four. Give
Oh,
me a number
okay.
for seven.
We'll say 4-4.
And why do you think it's gonna slowly creep up with the business rationale?
Well, I was gonna say in 2028 if they start scaling back tariffs with a new administration.
Yep. That should get them to what in 28?
Maybe so. Well, I guess they would probably still be realizing tariffs through all of 2028 from the current administration. So the reduction in tariffs would probably be 2029. But so I guess maybe still around that 4-4-4-5 number.
Okay, 4, 5, how about?
Yeah,
And 29.
probably maybe closer to 5, like 4-8, 4-9.
All right. So if I just take that scenario alone, you're telling me their share price would go up about $8.
Yeah, right. Yeah.
Okay.
If that's what the model says.
Now, what about growth? Can Costco, given the scenario, lower costs, better margins, grow faster? And about 6, 7%. Anthony?
Yeah, if Costco's making more money off of their expenditure, they're going to have more money to spend to grow the business. And I think with the headwinds of like tariffs impacting cost of goods, people are going to look to save money everywhere. So Costco, like more consumers will be looking for Costco, and Costco will have the capital to service those customers.
Okay. So it's not just more stores, it's more same store sales.
Hmm.
Okay. And so I'm saying this because this is the important part of this analysis. As opposed to saying, well, they're going to grow 9 versus 8. Okay, great. Why not? Why 8? And we can adjust that. Now, I'm for simplicity going to adjust it here. So we're just saying if they grow more, if long term they're growing about 6, 7, and they do some of the things that you just mentioned, Anthony, how much more growth per year compounded do you think they're going to get? So 6, 7.
If we're at 6-7 now, probably let's say 7-2.
Okay. So given your story, we put in 7, 2. Now, do you think anything's gonna change in tax rate?
Yeah, their tax rate will um well, that depends on what happens in 2028. I think their tax rate will probably go up because they're making more, but then it may go down in 2028.
So we're okay leaving that one alone.
Yeah.
Right. But if we do grow faster and we do get slightly better margins, now we're 1,300. So this is the idea of kind of a bull scenario. This is the scenario where things really go right. Realistically, that we can assume in the next 12 months for the long term. Okay, so we save our model. Right. And then basically, I'm not going to do this now, but then we create a bear scenario. Okay, what's the bear scenario? What happens to growth under the bear? What happens to margins under the bear? What happens to tax rate under the bear? Anything else, your inventory, PP&E, et cetera. And that's a more pessimistic scenario, which means your share price would be below 939. So the question is, how high can Costco go? We think it goes as high as 1372. How low could Costco go? I'll make up a number. I think it could go as low as 800. They don't have to be a symmetrical range for these reasons. And then we create model number 4, which is, okay, where do we think we're going to end up in that range? So somewhere between the bull and the bear, we put in assumptions of our opinion. It's still got to justify your opinion. Okay. And in a way, proxy, that is target. This is exactly what you're going to be doing for target. And so when I say write up assumptions, this is what I'm talking about. Like, why did you make the change in numbers? Because that's the valuable part. When you're doing these things in the real world, everybody can make a spreadsheet, but why did you use the numbers that you used? And that's the art of valuation. as opposed to the math of the valuation. But that's really critical. And that's what we're going to continue to practice. That's why, and we didn't do it here, that's why the EIC becomes really important in this process, right? Because if I know what's going on in the industry, I know what's going on with a company and their competitive advantage, their key issues, supply chain, AI, as was mentioned earlier, then that gives me context to making these changes. So even though you may not have one, you should still be thinking about it in that context. But generally, if you do projects, that's I'm going to give you all the data. And so that's why you're going to do an EIC before you do your evaluation in your group projects. Kind of makes sense. I know this is more detailed than we typically have. We usually have kind of some rambling conversations. But I wanted to kind of give you a sense of the process that you should be doing this week. Okay. And again, lots of practice. But to me, this is kind of the core of what we've been building up to. You know, why did we convert the statements? I know that's no fun, but it helps us create these kind of clean valuations. Right? Why did we do the EIC? Because it gives us the context for the assumptions for our valuations, especially the 5-year out, not just the current. Okay. And next week 6, we're getting into multiples, right? And we're going to triangulate. How do we use trading multiples to triangulate to make sure, law of one price, that the company values are reasonable given what people are actually willing to pay for the company? Okay. And by the way, multiples just rearrange math, but essentially that's kind of what we're leading up to. And that's your 15-minute group project coming up in a couple of weeks. So back to questions, comments, concerns. By the way, as we were putting in some of these numbers, what do you think about their 953 share price? Like if we were to proceed further, you saw some of the assumptions that get us there. The biggest one is the jump in the EBITDA margin from 4 to 5 in perpetuity at the current share price. And if you go back and look historically at Costco, and you look at their ROIC tree, so let's take a look at this. The model builds one. Costco's historical EBITDA margin, EBIT margin 3.3, depreciation 1 penny. So historically, it's been below 4 for EBITDA margin. We can also see this on the ratios tab. Historically, EBITDA margin for Costco closer to 4%. Can they really get to 5? Is that Costco's mantra? Because part of Costco, if you know that, is the founders really believed in low pricing. Wall Street's been yelling at them for years. Why don't you raise your price? And they believe in kind of this everyday value proposition of trust with the customers that they've built out. You know, if you walk into a Costco, that you're getting a reasonable margin on a product that you're buying. And that's been a very important bond Costco's had with their customers for well over a decade. 5% margin, different than 4% margin. What's changing about that? Might be reasons, but that's part of the answer to your valuation as well. Because Wall Street might think that they're raising their rates and raising their margin and getting better sourcing. Costco might get better sourcing and keep the prices lower, continue to drive that volume. That's been the secret to their success and their competitive advantage long term. In fact, where Costco actually makes their money is the memberships. That's just pure profit. That they have been raising. But prices in stores, historically, they haven't. So this is where we're kind of getting into the value. Thoughts, questions, about any of that? All right, so we're kind of, this class kind of bridged both last week, which was straightforward, we created the model, and this week, which is building out the valuations. I did get an email about the 2 exams that are coming up as well. Okay. And so basically your midterm exam is really your only exam, is broken into 2 parts. Okay. And so the first part is very straightforward. It's just an economic state conversion. You're going to start the exam, you're going to download an Excel file, and you're going to convert it into the economic statements. And that's just worth 10 points. There's 4 statements to convert. Each statement is worth 2.5 points. No different than your homework assignment, no different than the 2 practice files that I had put online, which was a midterm in a different class. But not trying to fool you. It's telling you exactly what it is. And by the way, in this class, all my exams are open book, open notes, no collaboration. Okay, can't work together, it's an individual exam, but I've never been a believer in testing people on their memories. Like, I don't know what skill set that happens in the real world. Right. So basically, if you need to reference something you've done before to help you answer the question, that is perfectly acceptable. Okay, you just can't reference somebody else's stuff or some solution from a previous year. That's not really right. But if open book, open notes, like I don't think that's a problem. So FYI, for either exam, that is allowed. So for example, if you're struggling with evaluation and you want to go back and look at the free cash flow of the one that you already converted to help you remind yourself how to do some of those tricks, absolutely do that on the part of the exam if that helps you get everything in the balance. Okay. So that is 10 points. That is the first exam. And then the second exam is really more on the theory that we have talked about so far this semester. Okay. And so essentially, that's called midterm exam part 2. And that exam is also open book, open notes. And it's basically just a series of essay questions. So for example, I'll give you a key value driver multiple sheet. And I'm going to ask you to explain it based on the scenarios we talked about before. Okay. I'll give you a CFI or an ROIC tree. I'll ask you to walk through it and explain it, just like you've done in the previous assignment. Okay. And so make sure that you put it all in there when you're doing your analysis. Don't like short circuit it, do the whole analysis and refer to numbers. Very important for the grade. And again, open book, open notes. But those are the 2 exams. So one's kind of like essay, answering questions similar to previous homeworks. The other one is just a straight convert. So I thought it was helpful to share with both of you. And the way the exams work is you can take it any time during the week of the exam, but once you start it, you have to finish it. Okay? You can't pause it. Because what will happen is it's on a 4-hour clock. At the end of 4 hours, it auto submits. And once it auto submits, I can't accept any changes. So I don't think anyone's gonna take 4 hours to do these assignments, these exam assignments, but don't just check out the exam, see what it looks like, go away. Because when you come back a day later, you would have submitted nothing and you'll get a 0 and lose 10% of your grade. And I won't be able to change that. So don't start clicking on either exam until you're fully ready to take those exams. Just a word of warning. So that was the exam question I got via email. Any other questions about what we're expecting you to do? Yeah, Lisa?
Quick question, the 4 hour time limit, is that specific to part one or part two, or is it like 2 hours altogether?
Each 4 hours.
Each is 4 hours, okay,
I
thank
don't
you,
think it should take 4 hours, but I'm just giving you a generous range. I know
appreciate
there's
it.
actions sometimes if you're at home, whatever, or but it just goes back to you can take it anytime. So just don't click on it until you're ready, and you'll have 4 hours for the time to click on it for each of the exams. And just submit within that time. If for some reason you do have trouble submitting, can have errors, and some people have done this, just send the file via email. Hey, I couldn't submit, send the file email. But send it like while you're doing the exam. Don't send it like 2 days later. That won't be accepted. Any other questions? All right. Well, thank you again for everybody's flexibility. Hopefully this was kind of helpful to give you a process perspective beyond what we just did in the videos. See a little bit more live. Sorry for my mouse trouble. I gotta adjust the trackpad. Something's going on here. But in any event, if you have any challenges, please reach out. And again, I'm going to be doing a lot of catch up tomorrow. I'm sending you files, grading last week's assignments, etc. So I'll spend a good chunk of the day working on that and getting it up there. Any other challenges with your group projects? Everybody good? All right. I have one team that I just want to ask a question before we left. You were the team that originally had picked EOS. And I know from your team you wanted to change, but I don't think I got the change. Did you decide who you wanted to change to?
Yeah, I think we're doing Alaska Airlines.
That's
Derek,
right.
Derek, I think you're on there too, or are on here. Sorry, I thought you sent that.
I'm sorry. Memory's not good this week. All right, so you are Alaska Airlines guy.
Yeah.
So I'll make sure I get the right data for Alaska. Anybody else having challenges with their companies? Are we all good with the companies?
Yeah, just hopefully to save you some time, we did Tesla, we got our data, so I think I sent you an email if you have a chance to make sure that we pulled it correctly from Bloomberg, but hopefully that saves you some time from pulling the files for us.
I'll look at that tomorrow as well. But one final thing I'll just mention about the data is that from a valuation standpoint, it is important to have the multiples, which will be the last section of the class, match the kind of DCF data that you're using today for the company. So I'm going to give you a second set of screenshots when I give you the multiples data. So what you have in the models, if you were to build one today, will change slightly, not dramatically, hopefully, but could change slightly in the next 2 weeks for your final valuation. Because the multiples really is the best practice, need to be based on the current share price. But if nothing else, you can at least start the valuation process with the data that I'm about to post there tomorrow. Hopefully that makes sense. All right, well, have a good week, everybody. See everybody on Monday. And again, this has been recorded, so I should be able to post the video shortly. Good night, everybody.
Thank you,
All right,
Professor.
thank
Feel
you.
better.
Thanks. Feel better.